All right, this is part two of my corporate finance discussion. I had an experience between the time I'm making this video and let's go to a page of this. This is our uh, this is our financial database, and I suggested in the last video, just a minute, I've got to open my slides. Okay, I suggested in the last video that, if you make a model, you need to start with what you think future cash flows are going to be. Everybody, knows that, and then value those cash flows. Those are the only thing you have to do. It's not that hard, is it? And then I made a little example, I think, with some dynamic arrays, and I showed you how the generic macros worked, and then we went through some fundamental value formulas, and then I hope what I did is I showed you a little model where we take a historic cash flow, judge what will happen to that cash flow in the future. I didn't show you the interpolate function with this one. And I talked a little bit about how crazy it is to assume this terminal value and this return will happen forever and this 3% growth will happen forever, and not really think about the philosophy of whether this company can replace absolutely all of its assets and make new assets and earn this kind of margin. In this case, we had a 14% margin over the cost of capital of 7%. These are crazy ideas. I also wanted to emphasize that when we make a corporate model, well, you need your little flags and you need your explicit period and you need your terminal period. And that's what you can do to make a corporate model. Now, if you're a fancy analyst who went to a big MBA school, you start going crazy. Oh, it's more complicated than this. Oh, it's too simple. And I heard this. Oh, man, did it irritate me. Oh, that's too simple. I got to do fancy stuff. I can do all of that. I can do all of that in a minute. Maybe you can. It took me years to figure out that instead of making some really fancy corporate model with all these equations, with all these assumption by assumption by assumption, and at the end of the day, you might hit a return that's totally unrealistic relative to the past, and your capex in your terminal period might be completely inconsistent with the amount of EBITDA you're going to make. And that invalidates all of that crap. And it just irritates me so badly when this arrogance in finance. Oh, I can do that. Oh, don't. And the really thing that got me. Oh, don't show me any colors. I can do that. I can do that. I'm so good. I can do all of that. Show me something really complex. Show me something really, really fancy. How disgusting. The nuance of a really simple model is so much more important. And understanding the craziness of making a terminal value. The craziness, now let's talk about something else. I think I have this in the file. Now, when you really look at these betas I calculated, I showed a company called NextEra. Now, they own a utility company that's probably had some bad news recently because it's in Florida, and they started out as a utility company, and then they they were called FP&L, and then they built all of these renewable energy, so they started to grow fast, and their operating income, I don't know what happened here, maybe they had a little bit bad, maybe they sold some assets here. So their they used to be earning 13%, and they had a 2 times market to book ratio, and then they're earning, well, whatever. You have to decide. You have to make a forecast of what they're earning. Why in the hell would you go and start saying, oh, I got to forecast every little pencil in the company, when you're not going to do that anyway? And then we could let's look at, I think you say Iberdrola. I don't know if you say Iberdrola. They're a Spanish company, and I think they... Did they do something with wind turbines? They've got a lot of renewable. What happened, you can see, when their returns were about 6%, their price to book ratio was 1. And then they have a beta of 0.9. Okay, we'll talk about this beta 0.9. This is, by the way, computed over the whole period. You take the slope, use the slope function in Excel, take the percent of the market change, or the market return versus the stock return versus the market return, and you can compute the slope in a second once you get the data. And now they're earning, who knows it, maybe around 12%. They got a market to book right now of 2. They had a little bit higher return. Maybe that would continue. Let's take, who should we take? Just a minute. I had an idea. Oh, here, let's take this one. This is a Hong Kong company. I'm not sure who it is. And sorry about that. I should know things. All boring companies. Okay? Oh, whoops. We did it in 2004. Let's get that 2014 out of the picture. Okay, and we look at their returns, and you can kind of see it. Now, I don't know the story behind this company, exact kind of regulatory hurdles it faces, and all of this. But right now, it's got a price to book of just about 1. It's earning about a 6.4% return, and you can almost say, aha, the cost of capital for that company is 6.4%. And this had the same beta as the other one, whatever that means. And I'm serious about that. I study betas like crazy. I study how betas change. I study how betas should be have a mean reversion or not a mean reversion. I'm not somebody who doesn't look at these things. And I am sure this man who is too arrogant to look at anything as simple as a model where all you do is you take put in a return, make a little table of book value. You start with the book value, the invested amount of a company, and in the end you get a result. And when you do this, you can prove to yourself with this simpler model or this one. And I'm not going to open these files, I suppose, these Excel files. You can look at those. The modeling is extremely simple. I just don't feel like opening them now. You can derive the expected returns when you do that, and those returns, and you can prove to yourself like crazy that if the return is stable and the market to book ratio is 1, that defines the cost of capital, and you don't have to go through all of these machinations with what's the equity market risk premium, how do we mean revert the beta, does the capital asset pricing work, what kind of risk-free rate you can get. You can directly test the cost of capital, and that's why I showed you these kind of things, which shows you for this company, I'm sorry if this is a review, this industry, we got a cost of capital of somewhere about 5%, and if you want to understand utilities, you understand that the cost of capital is low. Now, one of the things I didn't do enough is compare this chart, and perhaps I should have done these two and left this off, but that's okay, you can see the growth. This is this company who's had all the renewable assets, And who knows what the returns are, 6%, 8%, 10%. Maybe the future would be 11%, maybe 12%, maybe it would go up a little bit, down a little bit, somewhere around there. And with those returns, the price to book ratio is somewhere in the above 3. This is above 3, 2, 4, 5. It's really, really high with those kind of returns. Let's look at our Iberdrola again. Okay, well, no, that's not Iberdrola. This is Iberdrola. Who knows what it is. If you think it's going to be 12%, they get it 2 times, whatever. Maybe this 15% is going to happen forever. We don't really know, okay? Then, remember this, 3 times, maybe 2 times. Look at ExxonMobil. Look at the kind of returns they make. And the market is all hoping that the returns will stay up there if you kind of read up a little bit on them, or Shell or something. And at the same time, you get these returns, the price to book ratio is about 2. 16, 18, 31, 14, 6, 7, 8. This price to book ratio is far higher than this. It shows you that even this wonderful McKinsey statement, oh, everybody's got to earn a high return, that's all we need, high return, monopoly profit, charge higher prices to consumers, rip them off, get them addicted to things. That, it shows you that you can have a renewable company that's got higher multiples. Just that simple. Without going through some fancy regression analysis, some fancy elaborate proof that means goddamn nothing. Sorry to get so emotional. So sometimes when you make a simple analysis, maybe this is obvious, it's really difficult. It's not easy. Simple is not easy, okay? And I'm just reviewing this because I just had this experience, and then I talked about these powerhouse companies becoming companies that are throwing companies money away, like BlackBerry. First Solar is the best example of this. When it was earning really high return, and the market was silly enough to believe it could always earn that high return, and then it came crashing down, and this happened. Okay? Good. And then we talked about PayPal, and I talked about these crazy things about the McKinsey book. And basically that's where I left off, and I get to academics. And I have had new opinions about academics because of a personal experience I had that I don't have the guts to tell you about yet, but I will. And maybe you'll get a hint. And here's what I did for one of my assignments on cost of capital. I watched this video about Masters of Finance and Eugene Fama, the famous Nobel Prize winner from University of Chicago, that I used to think was a really interesting and good place, not because of their free market idiocy, but because they were really statistical and objective and analytical and didn't go through the bullshit of the Harvard Business School. And you watch this video, and I watched it 3 times the first time. I thought, oh, he's an interesting kind of guy. He speaks well, yes, he's got a little bit of a sense of humor. Oh, he's okay. And then I watched it again. What an arrogant guy. Oh, my papers were the best in 1968. I wrote this paper about this, and I wrote this paper about this. And you try to read these papers, you can't. Anybody who can understand his fancy little statistics is great. But if he makes really, really fancy statistics, you think, oh, he must be smart. And then the most interesting thing is this man named Richard Roll, who was he's another famous finance man. He asks these questions, and he asks, oh, well, we have to admit we don't know the cost of capital, right? And Fama doesn't respond. And if you don't know the cost of capital, all this fancy stuff is all worthless. So I'm going to talk about that a little bit, and then we'll get into some more. I hope I can find an Excel exercise as we go through a couple of these. Maybe I'm not. And again, I think a tiny little Excel exercise I hope that doesn't take away. My feeling about the academics is a lot stronger than my feeling even about the McKinsey book. Even that's how strongly I feel about them now, especially after some experiences I've had. They have a tremendous vested interest in overstating the cost of capital, because those rich kids who go to those fancy business schools, they want to go work at a private equity company. And all those private equity companies want a really high rates of return. And you have to justify those high rates of return. And here's my other point. Oh, they can do brilliant statistics, case studies, all of that. But they don't go through the philosophy of how things start. And they go through these complicated statistical questions instead of exactly the kind of graphs we were looking at. Take individual companies and try to figure out and try to get a story about a history of a company, and then you can aggregate that to the history of the economy. They hardly ever even mention terminal value, and the way they throw around these price to book ratios and all that in their case studies is disgusting. Nothing about really where it comes from, where any of this comes from. And they don't, here's their biggest problem. We make financial models. If you are watching this video, you are not you are one of the people who are not one of these arrogant people. And I am sorry I'm going off on these people. I hope I'm not being personal or anything like that. It's just these attitudes that derive things, and I put the last thing about Albert Einstein. Here's the definition. You can't even define the cost of capital. It's the absolute smallest. It's the minimum IRR that you need. The IRR is the growth rate, the minimum growth rate in your investment you need in order to make a new investment. And it's so important in the economy, and the way it's been treated is so disgusting. Here's my problem. The classic thing that academics do is they put a risk premium. And the risk premiums don't just stay constant. They're not just, the risk premiums compound on themselves. So if you have a crazy risk premium of 8.7% and a risk-free rate of 8.7, your risk premium in the first year you earn 8.7. If you've hold this for 100 years or 30 years, it's just mind-boggling how much money you get. This is not the annualized return. This is the absolute money you get over 30 years. 1,000 become whatever. 1,000. Becomes 34,000. If your risk premium is 2%, your 1,000 becomes this. It's always compounded, and these are enormous numbers they throw around without thinking about what they really mean. Now, I'm going to talk a little bit about cost of capital here, but we'll get into modeling again. I just need to talk about this for academics. I put on this. My friend Jeremy, he said this, he likes the Australians. So these are some Australians who each year they do this. You can go and Google it. I'm sure get a later one probably. Credit Suisse. Oh, well, they're not there anymore. Maybe but they still do it, I hope. They say, they have this estimate of how much you can make if you're in generation Z or Z, versus millennial versus baby boomers here. Baby boomers were able to make 6.7% real on equity. And they say, oh no, it's going to, poor generation Z, it's going to come down to 4%. That difference is enormous. And you can compare that with bonds that you made. Now, if you're making 4% on equity and it's real, what would you compare that to kind of get how much premium you make over and above risk-free? What we can look at is these Treasury indexed PS, whatever that means. And you can go and get that data. And on my website, I have all this stuff to get the data. I go crazy. it's kind of interesting. There was an election in the U.S. in 2012, and the real rate went down. There was an election in 2016. It went down. It went down in the election and during COVID, and now it's about maybe 1%, maybe 1.5%. So if the real interest rate is maybe 1%, maybe it could be zero. The risk premium, 4% minus 1.5%, 3%, 2.5%. That's what he says, and I think this is a pretty good one. Now let me talk about somebody who's no good. I was teaching at LBS, London Business School. I really didn't know who they were. They were wonderful to me, wonderful. But on LinkedIn, they compared me to this Damodaran to make me Damodaran. They did this to as a compliment. Oh, you're the Damodaran of project finance. Oh, I hated it! Because this guy is really destroying the world. When you really read what he does, it's such shit. And let's talk about, to really understand what's going on, let's go through some historic data. Now, I think what I should do is just again remind you about the making a graph with NA in Excel. So here, if you go here on this corporate modeling site, way down here, after I show you all of these different samples, I put that article about the risk premium, and then I put this file that just grabs all the stock prices, and with finance.yahoo you can. That's why I didn't really have a problem paying my $400 to them per year. I had a little problem with that, but then now you can't get those stock prices the way you used to. Oh, and I don't know if you can. Now I've got to look and see if I can download things automatically with Python. What I do now is I'll go through another video that, remember, I showed you this file, okay? And in this file we get all the data, and all you got to do is I do everything from Yahoo now. I gave up on MarketWatch. You just put this in, and then you run a couple of macros over here. You collect all the financial data, and nobody seemed to care about this. I don't see how you can discuss corporate finance without getting this sort of real data. Now, let me just pause for a second. Okay, this is the only little exercise I'm going to do, and in the last one I showed you, showed you all this stuff you can do with these dynamic arrays. This one I did badly. I should have, for the historic, done a little trick. I should have put if it's the true, and then we press the hash key if I can find it. Then we do the whole thing, and it gives you false at the end. Now, if you do something like this, you can put an average. Okay, and then you can take an average of this whole line, and then you can just press that hash key and get the average. And if you put the false in by using that little if trick, the average won't include zeros. And then you can do the same thing over here with the projected cash flow. So instead of multiplying it by, and let's say the projected cash flow is the average here. Maybe I should have put it down. Notice that what's happening, Shift Control Q, and this guy just complained about me coloring. What could be more important than coloring a sheet? Oh my God! Okay, then instead of doing this, it would say yes. And as long as these are all computed with that dynamic array method, we can then put this, and what will happen then? It will give us and of course I did it incorrectly because I meant to say, let's try, don't think this will work. If I put if not this, it won't work, will it? That's our projected cash flow. And it did. And I had a projected flag anyway, but okay, I learned something. All right, and down here we have a graph, and up here we can then put a discount rate. And again, this just shows that now I'm sure people, it's too simple, you asshole. Discount rate. See, I'm really in a little bit of a funky mood. And this time I'm going to say it's low, but of course, if you have a utility with just has a very low volatility, and this is, of course, is not real volatility, then we can kind of look at this graph, and maybe I can put higher volatilities in. How would I do that? I would have to kind of move both of these together, okay, because I want the average to be similar, but okay, I think you get the point. And if I do that, and then I put just a number 6 here, and very quickly put a spinner box around there, and they didn't want, no, don't waste my time with the spinner box, please don't waste my time, even though it takes about 2 minutes. I'll start with 4 and go to 12 or something, or maybe even higher, because people have these crazy estimates of the cost of capital. They'll go back and forth, link it to this one. That's how easy it is. And then I say take this one and divide it by 100, and then we can put these things up and down, and now we can make a graph. And we can make a graph. I'm saying, let's make a projection for 12 periods, and maybe we can make our projected period for 6 years. Okay, so we have 6 years of projection. How do we do that? I make a little thing here, and why don't we do the same thing? I can just say, all right, let's take this number, put a hash, and make it less than this number, and then we can, it spills, but don't worry about that spill. It's not like spilling coffee on the computer like what happened. I did not do that. Somebody in my class who was very, very nice did it. She felt all guilty. Of course, it wasn't her fault. And then here is the big trick. You use the NA function, and we put if, and there's another way. I tried to do this the other day, and I was going to make a video, but we can put if, and then we can put a little hash mark there. If it's true, we take this one and put our little hash mark here, and if it's not true, we put NA and open and close the hash. Oops, and this time I have to reduce it again, and it gives NA afterwards. And then I put our little historic period on our future period, and we take the whole all the way to 500, Alt F1. I'm going to make this, now this graph is crazy. Just a minute. I thought we for our projected cash flow, and I didn't even finish this. Just a minute. If it's not that, it didn't work. Okay. I need to do, if it's the projected flag, then that 6 was wrong. Okay, that maybe that's the only problem. I didn't see that 6 with the. That's after the coffee. No, it's not working. When I pressed F9, it didn't. It screwed up. Yes, it is. It is working. Why am I saying that? Okay, and now we compute our NPV, and we value, and we'll take a NPV and take this one, and then put a hash, not a hash, we put this one and a hash, and the good news then, I'm finding the hash, the good news for that one is that, let's see, I can't do it like this. How do I go to formulas, and if I just calculate now, it should give me a different one. Whoops, why did it just stop there? Whoops. Okay, it's giving me a different number, but if I put this to be 5, it would still begin correctly in this period. So there are just some little practical problems, and if you really did this, you'd use a half-year convention, and I've done all of this. So now I'm going to make this graph. I got worried about this graph again. I lost it, and I didn't spell projected right. I'm sorry about that. I should do a spell check. Okay, good. Now it's all flat, and that graph looks like a ridiculous thing because I'm going to 500 years and making all of that stuff in the future. This was alternate and F1 to get that. And now all you do is you right-click on the NA, and then once you right-click on the NA, you click on this date axis, and then I can change this around, okay? And then I can do something better where it says chart title. I can put an equal sign. Maybe this guy who objected to me so much, you know, and I'm going to do it like this. I'm going to put discount rate here and put an equal sign and put this one in. So now I'll just click on this chart title. This has to be in one single row. That was good that we did that. And of course, if the discount rate is lower, I'm sure it will give us a new kind of number, and we'll get a different value. Now, when I actually did this other one, but you can see, and then I can make a longer projection period or a shorter projection period. So that's enough of our little Excel. But I think doing some of these things is important. And if somebody says, oh, I'm too good for that, I am too goddamn good for that, well, tough. I'm sorry, I'm going to do that because academics won't do those kind of things, will they? Now, this is what my not friend, Damodaran does. He claims that this equity market risk premium, instead of these people who say it's about 3% or something like that, maybe 2.5%, maybe 3.5%, he says his recent number is 6%. And it sounds like that's not a big deal, but it's an enormous deal. And the fear I have is all these people go to this Damodaran website and take his stuff without reading what he says, and I didn't spell his name right, and I'm sorry about that. I think one of the most interesting things to do with data, and perhaps I'm going to stop this video after this section and make a third part of this video because I don't want to just blabber on too long. I get in trouble for blabbering on. Let's compare the S&P index with corporate profits. And you can go to the Fred website and get nominal corporate profits, and you can compute an IRR, a growth rate. Basically, you take this, and you take the difference. Or you put a negative on this one and a positive on the rest of them. No, you don't. You just take it over the whole period. You're going to buy and sell, and you don't get really a dividend in between. Well, maybe you do. That's a good question, actually. I never even thought about that. Here are corporate profits. Here's the GDP. And here's miserable old us earning a median income. And I get very jealous, and I get these kind of graphs make me nuts a little bit. If we look at what you've earned in the market versus corporate profits. Now, if you look at this graph, there was a big increase in the value, the price to the earnings ratio here. And then there was a big decline with the dot-com bubble. And then profits went up and the whole economy declined and profits went down. So there wasn't this price to earnings ratio. And then here, the price to earnings started kind of going really high again. And as corporate profits are higher than the overall GDP index, the rest of us get left out. And what that means is if you are making an assumption that corporate profits can always grow very much higher than the GDP, or if you make an assumption that these price to earnings ratios can really skyrocket forever, it's kind of crazy. You could, better than Mr. Damodaran. Now, none of these, these are all real numbers, by the way. I should have been clear about this. The take away inflation, you should always take the inflation away. The real economy grew, if we go all the way back to 80, here it grew at a little higher than 2%. Okay? Domestic profit. In us, we only grew at less than 1%. Profit grew at about 3%, a little bit more than the economy, and the stock grew even more. If that continues forever, people who own stocks get really rich. And you think you own stocks, big deal. You don't own stocks. Elon Musk owns a lot of stocks. Bill Gates owns everything. These people, there are small, very small percentage of the people in the economy, 1%, 2%, 10% maybe, who own just about all the stocks. The rest of us are shit, okay? Now, what I did there is, this is the way I used to do it, and I didn't understand that finance.yahoo has something else. Now, this is nominal, and this time I show the volatility, and I show different series, and they have a series called S&P 500 with dividends, and that series started in 1988, so we don't have any historic data. If you add dividends to the S&P 500, the S&P 500 does not have dividends in it, which means it's kind of a meaningless number when we look at it in the context of the overall economy, and this is remarkable. The S&P 500, you would have grown at, with dividends, at 11.5%. Oh my God, when median income with inflation grew at 2%. This difference, this small difference in growth over really long periods is enormous. And how do these academics not start every single course that they have with this kind of data and understanding what can happen? And the question is, can this happen in the future? Now, this one has it in real terms, but still in real terms, it's absolutely enormous. 8% in real terms when the economy grew by 2.4% is unbelievable. And look, it didn't really start growing until about 2012 when you started having Apple, Google, Facebook, and all that being dominant people in the economy, earning these enormous kind of returns. Without the kind of profit, you had this enormous change in valuation. Now, it could be, let's go through what could happen. Possible explanations for this. It's really a mystery. And we need to think about this. We need to try to understand why this could be occurring. Well, it could be occurring, maybe this is the U.S. economy, and maybe these stocks all, are worldwide stocks. They own some South African things. They rip off people in China. They earn their money all over the world. Maybe that's an explanation. So comparing, and maybe the way the government reports these profits is not very good. Maybe that. Okay? Possibly. But we have this enormous difference between this one, and the blue one is not a big difference. This enormous difference between the return you realize and the economic and the economy. My only possible explanation is that the cost of capital, the real, not the nominal, the real cost of capital has declined dramatically. If the cost of capital has declined, that pushes the PE ratios and all those kind of things way up, which we can't even measure anymore, really, when we go through all of those individual stocks. And when somebody says, oh, here's the overall PE ratio for the S&P, we're going to go through PE ratios and all that in in just a minute, and not this one, because where are we? Okay, so if you take this now, this wonderful, the Fred, if you get the data from Fred plus Yahoo takes the S&P 500 and goes way back. Unfortunately, it doesn't do that with the dividends. So this chart isn't really quite right, because I use the S&P 500. But if we go back far enough, you start to see, well, this is where this it's Ibbotson, Singfield, and then where what's his name, Doran says, oh, I've got this great data. Well, you can find that data. I've put it in another spreadsheet. You've got to go, and it's in the spreadsheet, actually. I could do it. But if you go back far enough, you see, oh, this wasn't always like this. The economy and the income kind of grew. Maybe median income isn't a good statistic, because maybe we should take median total household income, not just the income per capita. So maybe we've got to increase the population size. So I admit that there could be problems with the data. Please, I'm just trying to highlight some of the issues, and something very important too is to show that you can do this yourself. And doing this yourself, if you had a person, if they would hire me ever, but they don't, who cares? I would start a class like this to try to understand what's happened, and over a really long period, you don't see the same phenomena. You don't see this enormous wealth created to a really kind of small group of people who got lucky to invest in Microsoft and other things like that. You don't see this over a really long-term period. Now, part of this is the interest rates have come down, and really you're talking about real interest rates, and you should understand that in the context of these things. I suppose we could look up on this one again. When real interest rates come down, then the discount rate should go down, and the valuation goes up, but that doesn't explain what's happened very recently either. Okay, and so this is the craziness of using 6%. Now, this other man, I testified against him, and I'm going to complain about academics again. I testify in court, and I take strong, aggressive positions, and I often lose because it goes against conventional wisdom, and I have people screaming at me all the time. But this man said the equity market risk premium was 8.7%. Now, if you take all the value of stocks and let them grow at 8.7%, and the value to investors go up at 8.7 by about 20 years, there's nothing left for the rest of us, because the economy grows by 2% or 1.5%, that's what people were saying, and the stocks grow by 8%, real, by the way, real, not nominal, and that means the remaining share goes to zero. It's just can't be. Now, there's a really good book called what is this? The equity market risk premium. I've got it on my website all over the place. I'll put it on there. A lot of people said the equity market risk premium should be zero. Some people went up to 4%. One person went to 6 to 7. What a crazy number! Kind of the average is 3.7. Those numbers make sense, and this number makes sense. So we need to start by thinking. This is just an illustration how academics, and of course this Mr. Dr. Fama, oh my God, he didn't talk about any of this stuff. Here's another thing. This is just a little example. There is a study by a man named Bloom in the 1970s. And he went back in the 1970s. He went back to 1926 to 33, 33 to 40, 40 to 47, 47 to 54, and he concluded that if you put portfolios of stocks together, they eventually converge. So if we can take one, a low portfolio went high, a low went high, a high went low. Not really dramatic. companies and competitive companies, as they grow, they become kind of boring conglomerates looking more like the rest of the industry. If companies are in a really low risk, maybe they ought to get a high risk, but it doesn't mean anything. I looked at this for utility stocks, and I separated kind of the time periods. Now you can do this really easily, and you don't find anything like this. There is no convergence to one. There is no history that says all of these companies gradually get a beta of 1. The way Bloomberg still has this mean reversion bullshit in its betas. I'm sorry to be swearing so much. I'm getting a little emotional. There's that U.S. election and everything. Oh, God. So that's enough. And here I put some other stuff about WAC. Okay? Let's go through a couple of other issues. I've been talking about, I'm just checking the time. I've been talking about returns. And we talked about returns. If you have a single asset, the return on a single asset starts really low and goes really high as the asset gets depreciated. I hope that's not a surprising kind of result. So if you have one asset, the return is not the same on that asset, even if the income, the EBITDA, the cash from that asset is the same all the time. That should be known by everybody. A single asset, the return starts low and goes high. That should be basic. And here I compare the IR. So if the IR is 10%, the return, if we have an inflation rate of 3%, this time I have inflation, is 4%. 10% is the IR. You get a really low return in the first year, and then it skyrockets after that. Okay, now, if we look at companies, in this case, a company's capex to depreciation was going down, so eventually its assets, this is General Electric, its assets are getting old, its return should be going up because its assets are going, its assets, blah, 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 are going down. And we can't compare that to another company who in this case, this is a renewable energy company, and I can't really see these. I'm sorry I didn't print this out very well. But this is well more than 100%. These returns cannot be compared with these returns because these returns now, the company is investing heavily like Amazon or something, and the returns will be understated. So in a way, I'm a hypocrite. In a way, I'm a hypocrite because I said, what we have to do is forecast these returns up here. And once we forecast these returns, then we can throw that into our little model. I'm going I shouldn't have gone back up in these slides. Here it is. We forecast the history of these returns, put the future of these returns, use a wonderful little interpolate function to get that. And then, I'm sorry to go back, oh my God. To go back to this, once we have once we have those returns, we can get the value, and that's really not quite right. We can have other totally horrible distortion in returns. One is, this is example of Macy's, this store, and they have these gigantic write-offs, and after the write-offs, the return goes up. The book value goes way down because it's kind of a non-cash write-up. So you write it off, and then your return goes up. And then they go to the investors and say, we're earning a good return. Our business is going to it's going to hell, but we're earning a good return. And they're earning a good return because they took a write-off. And how do we take all of these courses that you have in these MBA schools with financial statement analysis and all that? How do you take this data and if you have especially a non-cash impairment write-off, your investment, your true investment didn't change, but the reported investment goes down, which means if you're earning the same income on a much lower investment and you have a lower depreciation, it goes down. And this is BMW. Here they changed the inflation, and you get all of this, by the way, from that database that I showed you. the depreciation rate changes dramatically. And when the depreciation rate here, it was really high, the depreciation rate. When the depreciation rate goes down, the return goes up. Of course, that has nothing to do with what's really happening. Okay, and I think that's enough. I made it through that. I think I'm going to talk a little bit about multiples next, and and then I'm going to talk about project finance versus corporate finance and building up portfolios. But I'm going to have a heart attack, I think, because I get too emotional about some of this stuff.